Good afternoon, everyone. We are just waiting for everyone to log in. Thank you very much for joining us. We'll get going in 1 minute. Right, good afternoon, everyone. We will just get going now. 1 second, people logging in. Excellent. Cool. Thank you very much, everyone, for joining this Intellidex briefing on the COVID-19 outbreak and how it affects South Africa in particular. I'm joined by my colleague, the Executive Chairman of Intellidex, Stuart Theobald, who is there as well. We're going to whiz through a quick presentation. There's going to be plenty of time for Q&A at the end, certainly. We're going to show you a few slides on the macroeconomic impacts, some stuff on the banking sector as well, but I'm sure there'll be lots more questions after that. You can type questions as we go along or at the end. There's a Q&A function there should be in Zoom at the bottom of your screen. There's also an ability to raise your hand and we can have you ask the question live as well. So do either of those, or if you're on Bloomberg IB, you can tap me as well on there and ask your question. But thank you everyone for joining. We're about I think 150 people now have signed in, a few more maybe to come. The briefing is on the record. We do have some media attending as well, and we'll get going. Thanks very much. So we've basically been obviously tracking the outbreak of COVID-19 since it first reared its head in Asia. We started thinking about the economic impact as we were worried about downgrades to global growth, even at the end of or through February. But the crisis in South Africa didn't really get going until the 15th of March, when we had the declaration of a state of emergency. And we're going to have a look here at some of the thoughts we have at this moment in time. A lot is uncertain. It's very hard to estimate these sudden shocks on the economy. But Stuart and I have both been very lucky to be part of a group of economists as well, led by Miriam Altman, who have been mulling over these ideas in a lot of detail. We brought a lot of modeling and banking sector expertise into that process. And so we'll go into some thoughts on the stimulus package as well, and the recovery from there. But I think the key takeaway we have at the moment, and we've had for the last month that we've been communicating with clients, is basically that the economic shock, I think, is going to be a lot longer lasting. The crisis itself is going to be a lot longer lasting. We worry about permanent losses of output, permanent steps up in unemployment, and this is not a sort of normal shock in the sort of normal macroeconomic sense of the word. So the crisis clearly started with imported cases, a large number of people coming first into Durban and then into Joburg, who were skiing in Europe, was the sort of start of the outbreak. And we saw South Africa act very early in terms of the response to the health crisis. We should remember a state of a disaster emergency was declared on the 15th of March. That was very early. It was before the first death had occurred, certainly. And a lockdown was then put in place from the 26th of March, which was just before, a few days before the first death was declared as well. And as a result, South Africa has this very different curve in terms of the cumulative number of cases to many other countries. We saw a sharp kink, which you can just about see on that graph on the bottom. That's showing the number of days after the 500th case. And this sharp kink basically was caused, we think, by the stoppage of a large amount of tourism and foreign travel, but particularly the closure of restaurants and bars, which started before the formal lockdown. That started from the declaration of a state of emergency and seemed to start to put us onto a slightly different path. There was an initial stimulus, let's not forget as well, that was announced. We saw the use of the UIF, for instance, to promote some forms of unemployment benefit into employers, but that really was very, very small. The total package was only maximum about 1.5% of GDP, and really much less of that was actually deployed in any sort of timely manner, and hence calls started to grow for a much larger package. There were those famous graphs that showed South Africa up against its peers, most of its peers doing sort of 5 to 10 percentage points of GDP of stimulus, and obviously some developed markets like the UK managing to get up to almost 20% with the deployment of both fiscal and monetary balance sheets. I think the fascinating thing has been, as we watch in particular a slightly more reliable statistic, which is the number of recorded deaths, still not perfect. We've tracked on that top right-hand graph the doubling time in the number of days for the confirmed cumulative death rate, and that's steadily been going up, which we think is showing that the lockdown is clearly having some impact, and we've seen in particular a degree of isolation occurring between, particularly effective in sort of middle class areas. But the real problem we have from here is testing increases as we now go into a sort of phased and flexible de-lockdown or different sort of lockdown from this Friday. Is the advice and the modeling from the Department of Health, which was presented, the bottom right graph, to Parliament 2 weeks ago now, really showed that actually the official estimations are that we're in this sort of odd preliminary phase, if you like, of the outbreak. That as winter comes in, as we see in particular, a colder climate, as we see some worsening of underlying respiratory health, the onset of seasonal flu as well, that actually the main ramp up in cases the Department of Health is expecting is really through July and August. And the peak they're saying back then when this presentation with this graph was given, but also today in a briefing from ministers, the peak is still expected at the start of September. And now that's a very, very different narrative to Europe, where you're sort of coming off your peak, where you're seeing a resumption of normal, if the next maybe phase in the winter in Europe quite far away. South Africa now has a full sort of 5 months or so of this grinding crisis at a moderately slow rate going on, but at the moment, but really the fastest and the worst is yet to come in July and August, into that peak in September. And I think that still takes people by surprise. I think it also raises a lot of questions about why the lockdown is being eased from this Friday, how it's done in particular, and also how that will have to change. As obviously, as you get towards that peak, there's going to have to be more lockdown, and hence we've been cautioning a lot to clients that we may well see a temporary phase of stage 4, but actually have to go back towards a much stricter lockdown later on. And clearly, that has a much more dramatic impact on the growth outlook. So just to guide through how we've been shifting our forecast since the start of the year, we started off still not great number at 1.2 at the start of the year. That was basically seeing some degree of recovery, but then we had load shedding. We had some pretty poor Q4 data that revised that down. Then we revised down again, I think this was at the end of February into the start of March, when we basically saw people like the OECD, the IMF and others coming out with much weaker global growth forecasts. And also the closure of the border, the announcement of the closure of the border in South Africa, for us was a key moment in the economy, with such a large sector in tourism generating such significant revenues. Net tourism flows are about $17 billion a year. And that for us was a key moment where we revised down then to -2.3. A lot of criticism we had when we made that revision down. But I think at that point, a lot of people, particularly policymakers, were still thinking of this crisis as a kind of very large but normal shock. We then had the 3-week lockdown, some stimulus with rate cuts. As I said, the deployment of UIF, etc., though we were always very skeptical on that, but we did pencil it in. The lockdown extension, and we basically got down, thinking then about this flexible lockdown to September, to about -16.5%. And I think the key there that I think people still struggle to get their heads around is a long period, even with a relatively small impact on GDP, if we want to take a more optimistic view between now and September, is still going to have a significant impact on GDP. for such a prolonged period, especially if we think that you have to go back then to stricter forms of lockdown, as we see the fastest increase in cases through June and July and August. We then added back in the 500 billion stimulus, and so our formal GDP forecast at the moment for 2020 is minus 10.6. The graph at the top right, we just sort of lay out how we come to some of that calculation. GDP per day is roughly, or was going to be at the start of this year, roughly 14 billion rand per day. We think there's an impact in stage 5, the full lockdown, of around 8 billion. And in the coming stage, on average, we've taken a lower number, around 4 billion, roughly half. We have a more detailed sectoral view behind this and how it impacts individual sectors. But the key for us is this sort of tail that comes off the back of it through the rest of the year. The impact on a permanent loss of jobs that can occur, firm destruction, particularly for SMMEs. And we're thinking about a very large estimate of about 1.7 million jobs lost for this year, mainly in the sort of SMME sector, but also some very large companies as well. We've seen news around Edcon, there's obviously stories around SAA and other large companies as well. And so whilst this number appears very, very big, actually when you start thinking about this type of shock, the fact that a survey by Stats SA basically showed that most companies, I think it was about 8% of companies don't have savings to last them beyond 3 months. It was about a third didn't have enough savings to last them longer than a month. This idea of firm survivability, we think, is quite crucial and sort of underplayed at the moment in analysis of the crisis. We then had obviously the stimulus announcement. I said we brought our GDP forecast back to about minus 10.6 as a result of that. But there's a lot of sort of PR, I think, going on around the stimulus. We have to think very carefully about what's really going on. And there was an initial number of 500 billion, then 800 billion was mentioned. The 800 billion basically includes a number that comes from the SAR, which is basically about the relaxation in capital and liquidity rules that was made about a month ago now, which we don't treat as stimulus. We think that's an accommodation for losses. It doesn't add anything onto GDP for us. It protects the banking sector. It's certainly a good move, those regulatory changes that were made, but it's not a stimulus that lifts up our GDP forecast. And so we discount that. Of the 500 billion, of course, a significant part of it is reprioritization of existing spending that will be negative on growth. There's also on top of that, of course, the bank lending program, which is off balance sheet as well. And I think the key for us is that the way this was formed basically was a working backwards from a need to show about 10% of GDP stimulus, which is 500 billion. But for us, what's been missing really, I think, is this sort of more liberal lack of sort of detailed bureaucracy that we really require moving forward, thinking about how you phase the economy. And I think what struck me, and I think struck Stuart as well in this process, has been how many people in government, particularly the securocrats, the people who want to have very close monitoring and fiddling, the microeconomic fiddlers, as I've termed them, want to have a very, I think, hands-on approach to how exactly you sequence these stages going forwards, inspection regimes, form filling, etc. And that it all works very well theoretically. I think, you know, the theoretical construct that the government has come up for the next stages kind of makes sense on the surface, but we have serious questions about how that really is applicable in practice, particularly if you're shifting backwards and forwards between stages, the complexity of what is and what isn't allowed at different stages. Adding in a curfew as well from 8 p.m. to 5 a.m. we think adds a significant degree of risk around execution as well, particularly as we've seen what's happened in the first stage of the lockdown. And so I think the debate has become framed in a slightly odd way. You're either sort of for or against the plans, etc. And I think that sort of misses the point. There are other ways of doing easing of the lockdown. There are other ways of doing the initial lockdown as well. And we need to remember this is still a substantial amount of time before we get to the peak of the outbreak. We've put together here some just a general summary as we've tried to sort of make sense of the different stages of lockdown, going from sort of 5 at the top down towards the bottom. And I think it really drives home that sort of generalized unlocking of the economy in particular tourism, but also sort of general retail, opening of bars and restaurants, is really going to be out of the question until the very end of this lockdown process. And if we assume again that we're getting back towards higher stages at some point, that really is some way off until the end of the year, and we've included that in our forecasts for growth as well. Just running through the stimulus, there's been a lot of discussion of the impact on GDP. We think the most effective part certainly is the bank stimulus to come through. The table on the right-hand side there showing the impact that we think this will have through a multiplier effect into growth. And we're basically quite skeptical that you get a big increase in GDP from, for instance, the jobs protection program, where there are no details yet from government on that. We've been quite conservative in terms of the view of how that really can boost GDP. We have to remember we have to take something off growth for these the reprioritization of existing expenditure. It's very, very hard actually to see where that's actually possible or can come from in an easy manner. If you can't cut public sector jobs, you're going to have to cut really infrastructure. Is probably the easiest thing to cut or to delay at least, and that certainly is going to have a negative impact on growth. We've assumed some pretty low multipliers, things like SMME support as well, where there's been significant problems in terms of really trying to get that program going as well. And other things like the distribution of grants and unemployment benefits. The grants is sort of easy to step up, but the unemployment benefit is going to be exceptionally hard to put in place, and trying to sort of crowd in several million people into a new system, which normally one would have designed and sort of implemented and trialed over maybe 5 years even, is going to prove exceptionally challenging from here. But overall, from this notional headline 10% of GDP stimulus, we add back on about 6 percentage points onto GDP for the impact of that. I said much uncertainty over this, much likely delay, a lot more detail required. A lot of things can change, in particular on the revenue side. We're going to come on to talk about cliff edge issues in a minute, but some of those sort of revenue holidays we think may have to become permanent at the end of the year, for fear otherwise of having a too limited effect on the economy. When we pass all this all together, we get to a sort of 17.7% of GDP deficit for this year. Clearly a record, exceptionally challenging to see funding. I'm going to come on to funding in a second. I've had a lot of questions before the webinar from people about funding. But I think the key thing really is to remember that you have the impact of the stimulus coming through net with some of the reprioritization that government's penciled in, but you also have an underlying revenue shock as well. You're going to be seeing people consume less VAT paid. Very simplistically, no one in the economy is going to be making a profit this year. There'll be no profit tax collected. You're going to see less trade and fewer sort of import duties, etc., collected anyway because of lower growth. I think people have missed this sort of 230 billion, as we estimate, shock to revenue, which will come through on top of that, and that really is a significant component then, which really drives the funding need going forward. But to briefly summarize the funding view before we get onto the detail, we're not as worried about 2020. The issue for us is really what happens in future years. You get stuck at a 10% plus deficit. A lot of these sort of things, temporary measures like unemployment benefit that are now being rolled out, politically maybe have to become permanent. You're seeing maybe a big step up in grants that can't be reversed, and that's going to be the massive political challenge here. You're going to have these lingering effects in terms of unemployment, where the right thing socially to do is to extend those kind of benefits until that kind of shock has faded, which will be a long time, but simply no particular fiscal space to do it either. So we're much more worried about the future fiscal years and how you add up funding once you've used IFI funding for this year. But there are things government can do. We need to see a fiscal rule put in place to anchor some kind of consolidation back from here, to keep markets and bond markets in particular on side. And we need to see an emergency budget very fast in order to see the full detail of the government plans. There's a lot of uncertainty we've had to grapple with in putting our forecasts together, but also to see that sort of 3-year MTF type process from government and from National Treasury to be able to see their plans and see and test credibility of those plans against likely funding. But as I said, the big worry we have more than this year is getting stuck at a very high deficit in future years, which really then generates funding problems. So that so I said I'll come on to more detail on the funding side. A lot of numbers here. I mean, basically the full WACC funding requirement for us is about 1.396 trillion rand. That includes redemptions and includes the existing budget deficit and funding plan that National Treasury put out in the February budget. They assumed a 13% step up in SAGB issuance in the budget. But it's clearly going to have to be more than that. The SARB is providing support, of course, with not QE as we term it, liquidity support, not targeting yield levels. That we think will allow them to do a larger step up. But really, we think they're coming up against some kind of limit here in terms of this sort of circular logic between how much you can fund, how much the SARB does, and how much the market can absorb of extra issuance or what yield is really, we think, straining at the seams if you're starting to see a 25% step up in SAGB issuance. You can add in a little bit of extra cash usage. The current cash stockpile of government is about 236 billion. We think that can maybe drop to 150 or so. The UIF can buy some more bonds. There's a COVID-19 bond could be issued, of course. We'll come on to that maybe later. But you still have this really chunky hole left at the end of all of that of about 269 billion rand by our forecast. Now, you could try and push the market. You could do a lot more in terms of SAGB issuance, push that number, say, up towards 35 billion, sorry, 35% step up in SAGB issuance versus last year. I think the market would sort of kind of break almost under that unless you saw the SARB doing something different, such as a name size program or buying or something like that. There's government sterilization deposits. This is a complex sort of technical account that the National Treasury has at the SARB. Of money, a lot of legal questions about if that can be used or not, but there's a pot of money waiting there. But put very simply, IFIs are required. International financial institutions, offshore dollar funding is definitely going to be required to fill this hole. We add up a total of about $10.7 billion, that's 200 billion rand of funding available. The key thing is how this is going to happen, and there's been some unfortunate uncertainty, I think, from some of the press conferences and announcements in the last week or so on this front, where we think Treasury should be as open as possible about getting all the money they can to fill this hole. But what we're seeing now is a sort of a for now level of funding. 95 billion was the number that has sort of been put to that. That's this IMF RFI, rapid financing instrument, that's free of conditionality. Technically post conditionality, South Africa doesn't have to sort of prioritize ESCOM or anything, but you have to have certain prior conditionality, particularly around the state of your budget, having a decent fiscal framework, a transparent fiscal framework with the IMF. We're not there on that yet, but that will certainly come in the next sort of week or a couple of weeks. We think that South Africa can get that within maybe 2 months, that money from the IMF. Clearly going to cause a lot of political headlines, but I think broadly social partners in South Africa do actually understand this is conditionality-free money. There's then a very small amount of money from the World Bank Health Facility, and the other big chunk is the NDB, with New Development Bank, the BRICS Bank. That's 1 billion, which has already technically been allocated to South Africa by its board, but has to be drawn down as well. But all that's still not enough. We need more. There's then something called the contingent reserve account from the NDB. That's about 3 billion. And probably around $2 to $3 billion more of World Bank and AFDB money, which we think that National Treasury will tap later in the year, later in this fiscal year. Maybe it's hard to say when this has to happen. Our cash flow analysis of what Treasury gets up to says maybe that extra money has to arrive around July or August time, so before the MTBPS. But certainly this extra wave we think is going to be needed on top of what Treasury are talking about at the moment. The big long-term problem, though, is, and this comes back to this idea of getting stuck at certain sort of deficit levels, is South Africa needs to have significant nominal GDP growth. It needs to have sort of 8% plus nominal GDP growth, really to create the revenue space to absorb this permanent or semi-permanent loss of employment, of output, and to create the fiscal space, to create the tax revenues in the medium run that can really turn this situation around. The president announced as part of the stimulus plan that structural reforms would be the stage 3 of the stimulus plan to target higher nominal GDP. But I think we and investors give very little benefit of the doubt on that. There's been too many disappointments in the last 2 years around energy policy in particular, with how Department of Mineral Resources and Energy, NASA and others have reacted around liberalization of the energy agenda in particular, even though it's very jobs intensive. Some of the other problems around skilled immigration, issues like that, which would really help boost growth as well, have been deeply problematic. We've also seen the same, of course, on spectrum, which was very slow to get moving as well. And basically, I think government has to show a certain number of pre-commitments now on this front, really to get people back on side, or else people simply are going to pencil in long-term GDP forecasts that are insufficient to create this extra fiscal space that will be needed to lower debt to GDP. The only other options, though, it's our baseline, our rough baseline is that these reforms don't really happen fast enough, is you basically would have to have an IMF SBA. Now, the SBA is the classic sort of evil child snatcher that is sort of made out in political circles in South Africa about conditionality, but much of that is a myth. Really, the conditionality is nothing beyond what was in, say, the Tito paper last year, a little common sense that things that rating agencies have been looking for with investors, and particularly onshore investors, even forgetting for a moment about offshore investors, onshore businesses would be looking for as well, and onshore in terms of labor markets as well. I mean, a lot of what the IMF looks at is things like maximizing employment growth, at things like strengthening social security systems actually now. And so the myth is sort of just that. And I think that is the biggest pot of money South Africa could unlock, potentially up to $50 billion, which would then be required if you're not going to get that nominal growth coming forward. But would basically be strapping South Africa to the mast of reforms in order to get that money paid out. The other possibility is real QE from the Reserve Bank. The SARB would have to come out and say, for instance, they're going to buy 250 billion rand in a year of debt and basically absorb a funding gap that Treasury couldn't raise in the market. Not necessarily directly, though, that would be an option, but I think they would balk at that. But they could also buy that kind of bond volume through the secondary market as well. The final option is a Chinese bilateral loan. I think that would be deeply problematic in terms of the conditionality, the non-economic conditionality that would be attached to it. Potentially assets that are pledged, as we've seen in some of these Asian bailout cases, would certainly not be a free lunch that I think some people in the South African political sphere have been making out at the moment. It would be deeply challenging in terms of some of the requirements that would be made. So I'll pass over to Stuart now, and he'll go into a little bit more detail on the bank sector, and then we'll wrap up and already some questions coming in online. A reminder, you can ask some questions using the Q&A function in Zoom or by raising your hand if you want to do it live. So over to you, Stuart.
Thanks very much, Peter, and good afternoon and good morning to some of you. I'm just going to talk for a moment about the banking sector, what we're seeing there, and then talk about the bank guaranteed scheme in a little more detail. Peter, you're going to have to control the slides for me. Bank performance outlook is obviously going to be severely affected by this crisis. We do, in a sense, have a financial crisis on top of an economic and health crisis here. It will come through two primary mechanisms. One is the additional provisions banks are going to have to raise to cover a deteriorated credit outlook. Second is going to be a decline in new business volumes as banks simply can't do the volumes of business that they would have been doing in a baseline measure. There will be several other effects. Banks, of course, will see margins, interest margins decrease because of the endowment effect of lower interest rates. And we've seen in South Africa measures from the Reserve Bank, as Peter said, to decrease capital adequacy requirements and liquidity coverage ratios. These, as he said, we see as accommodative of what banks are facing rather than in any way stimulating the banking sector to increase lending. So our basic modeling, and there is extreme uncertainty, how banks are going to deal with increased provisions is going to be very difficult. The uncertainty is clear in the underlying health indicators. We just don't know exactly when the economy is going to resume full activity. We have to make some educated guesses, and all banks and their accountants are going to have to be making those guesses to raise provisions. We have seen globally central banks weighing in, effectively trying to guide their banking sectors to not be overly conservative in an effort to prevent banks from effectively withdrawing from the market. So to keep lending going, banks need to be to not be taking substantial provisions right at the moment. But in our view, assuming that we see a kind of return to the provisions we saw during the financial crisis. So currently banks are sitting at about 4% of their books that are provided for. If we see a return to the financial crisis, that'll increase to about 6% of their books. When you combine that to a fall in new business flows on the non-interest revenue side of their income statements, we're looking at a decline of last year of about 121 billion rand of revenue. That's going to leave the banking sector in a loss position overall. We're expecting about 35 billion in our baseline view. That 35 billion is accommodated within the Reserve Bank's capital adequacy changes. So that's what we mean by accommodative. It really meets what we're seeing happening in the bank balance sheets. It's easy to imagine scenarios that are worse, where the economy performs worse than expected and provisions are above where we're forecasting. We could also see better, of course. We might see some faster than expected recoveries that will allow banks to resume and decrease those positions. So we look at those various scenarios, but the ultimate point to take from this is that banks are under extreme pressure on their existing books, and the result is going to be a sharp decline in risk appetite among the banks and a decline in available capital to support new lending. So that's why, Peter, if we move on, the bank lending scheme is so important. Banks, of course, are going through a process of forbearance with existing clients, but if we are going to see new lending into the economy, it has to be done through a specific intervention. So as part of the economic package, a 200 billion rand bank guarantee scheme was announced. And of course, these are common around the world. Last count, where there were over 50 countries that have introduced some kind of guarantee scheme, and now South Africa will be one of them. The details of the scheme, though, are still being hashed out. There are many lawyers on both the sides of the banks and governments and the Reserve Bank trying to finalize details. There are many accountants also trying to finalize how things will be accounted for. And in our view, it's very unlikely that banks are going to be ready to roll out these loans by the end of the month, which was the guidance that the president gave when announcing it. We think we'll only start seeing some beginnings of lending programs next week, even though there is some urgency on all sides to get this to work. So how it works, just an overview, the banking industry is going to be issuing a standardized loan with standardized terms at a single rate that is yet to be announced, but we expect that rate will be at prime. Those loans are going to be available to companies with a turnover of under 300 million rand. Now, 300 million rand is we think, reasonably generous. It really reaches into the medium-sized company level, and companies with larger turnovers should be able to access other kinds of debt and equity. So it is a material part of the economy. There will be personal guarantees from borrowers. That will be a very important feature of the scheme. It's a 6-month capital interest rate holiday. If anything, 6 months is going to be tight, given the scenarios that Peter painted for you. These need to go until September before we even reach the peak of the health impact. So we can see that 6 months extending, and the loans will be on 60-month terms. At first, in order to get the scheme out of the door, government is giving a direct guarantee. That guarantee effectively amounts to 94% of loans, plus any margin that banks make. So we expect about a 350 basis points interest margin on the loans. That will be absorbed, and then a 6% impairment will be absorbed by the banks, and the balance will be guaranteed by the government, and any losses can be passed on to the government balance sheet. Now that 3.5% margin, of course, accumulates every year and compounds. So you can see as we move out over the 5-year life of the loans, the government liability will shrink. There is also a plan, we understand, in a phase 2, when there's been enough time to put it in place, an intention to raise a fund to absorb some of those guarantees, and that fund can be raised out of concessionary finance and other sources that government may be able to access. Peter, if we move on. The concern from the effectiveness of the scheme is just how successful it will be in reaching that 200 billion rand target. As Peter explained, this is a really important part of the overall government package with the highest GDP multipliers, and really the key intervention to try and prevent corporate distress, to keep companies open, to bridge them through the crisis. So it really is important that this scheme works. But we've seen from the global examples that there are some that work and others that don't. So to just put two extremes to illustrate the point, we've got on one side the Swiss scheme, which made loans for small businesses of up to the equivalent of 9.6 million rand. Those were at interest-free and 100% guaranteed by the state. Companies could self-declare, so there was no real assessment of companies, and they could apply, and those loans flew out of the door, as you can imagine, and within a week, about 273 billion rand had been lent. In contrast, the UK scheme is widely seen as a failure. The Chancellor announced various changes yesterday to try and get the scheme functioning better, but so far take-up has been very small. The reasons for that slow take-up is that bank credit assessments have been quite thorough. Companies have to prove that they really have been affected by the COVID crisis. They have to prove that they don't have any other financial resources available there to them to access the loans. And plus, they have to put up all assets and sign personal security for those loans. There are now exceptions for smaller amounts. Government has increased the guarantee from 80% to 100% on smaller amounts as well. So the various tweaks are being implemented. South Africa's scheme at 4% of GDP is quite large compared to others we've seen around the world. The UK so far has only gone up to 0.5% of GDP in terms of what's been lent so far. But so there might be some tweaking over time as the Treasury and Reserve Bank, together with the banks, work out just what's going to work to getting loans out the door to businesses where they're needed. So there are certainly in our minds some questions about the effectiveness that we're going to have to test over time. And we're certainly going to need to see how quickly banks manage to get the operations in place to be able to issue them. In terms of bank earnings, we see these as effectively a non-profit activity for the banks. There are issues on the accounting, what provisions they're going to have to make for these loans that are still being fought out between regulators and accounting firms. So those will be important to really drive bank appetite to ensure the volumes of loans happen to support the economy. I'll leave it there, but we can discuss more in questions. Back to you, Peter.
Thank you very much, Stuart. So just to wrap everything up, I think the key issue for us is how policymakers basically should avoid these permanent losses of output, permanent destruction of firms, and the narrowing of fiscal space in particular is this nexus of challenges that really are coming to a fore right now, certainly, but into this recovery phase. I mean, the problem we have is saying minus 10.6 or so for GDP this year, with then only seeing maybe plus 4.5 for next year, which people think sounds very, very large, but really actually is quite small considering the very negative base. And this sort of 1.7 million jobs lost. Thinking forward 3 years, even under some more optimistic scenarios, we can still see that versus previous trends, you would still be down maybe around 1 million jobs or so with this kind of profile as well. And hence that crucial importance of having nominal GDP growth really coming to the fore. So we just wrapped up some issues here. A lot of it coming around this problem of a permanency loss of output. Cliff edges as well, how, as Stuart was saying, if interest payments start kicking in for bank loans, grants are meant to stop. New unemployment benefits are meant to stop through the end of the year. It's going to create huge political challenges at that time. And a lot of it will come back and rest ultimately on a discussion of what is fundable at the fiscal cliff edge. And that ultimately is a conversation between the National Treasury and the SARB, and indeed National Treasury and the IMF as well. It is possible to think about a number of different routes that are not maybe as constrained. You could think about the SARB sort of stepping up some developed market style program, but our view basically is the SARB will always lag in terms of coming to the party and still want to be conservative in terms of what they're offering. We think ultimately they would only do real QE, said earlier, after an IMF SBA with conditionality was really already in place. And I think the step up in inequality as well is going to be a particularly crucial issue to watch. How the economy changes, particularly if there is a vaccine or not, if you can have, say, antibody health passports or something like that. So ultimately, probably going to benefit people who particularly can work from home or can work in sort of richer services industries in Santon, etc., as opposed to the average man on the street. I think is going to be this key political issue around inequality, which we're going to have to watch as well. And the issue of economic nationalism, we've seen this starting to creep in. When the president said on announcement of the stimulus package on Tuesday last week that a new economy would have to be built, that's going to be a hugely politically contentious and fought over issue, in particular, as came up at the press conference on Friday. Should restaurants employ only South African nationals or not? These kind of things which have boiled away in the background but never really come into serious policy discussion are now going to be coming front and center as well. I think as a result, it's going to be a very fascinating time to watch how the political economy is flexing and what the outcomes are that can affect, let's remember, not only positively the recovery, but also negatively as well. We can see foot shooting opportunities as well for government if these kind of steps are missteps are taken through this recovery process as well. So that's the presentation for now. We've had a lot of questions online. People have been emailing me. There's been lots of emails about my beard. Thank you, everyone. We will take one. I think, Stuart, you can open the Q&A thing as well from Claire. Maybe if you want to take that one first, about what the other ways of doing lockdown were. We've seen, I think, and this hasn't fully been discussed in public, they've been seeing a lot of other conceptions of what lockdown could look like. The one that was chosen was very bureaucratic. And that really ties into another question that I got on email as well, which is about what the alternatives really are. And who is driving the current conception of what the next stage of lockdown look like. So Stuart, do you want to start on that?
Sure. I think, Claire, as Peter says, a very bureaucratic approach has been taken. That's going to be extremely complex for businesses to understand. But we're going to have a patchwork economy, both geographically and in terms of economic sectors being opened and closed, depending on the health outlook in those areas and the protocols that those particular activities can meet. Now, an economy is complex, so that means pieces of the supply chain are coming in and out, which we think are going to be extremely difficult in practice, that businesses are going to struggle to really function because some or other inputs are not going to be available at some or other point. So even if you are out of lockdown in theory, you can't really function fully. What other ways are there to do it? Look, I think there's a lot of debate and a lot of thought that has to be put into that. One of the issues as we see it is to just look at the economy as an adaptive system. It adapts to what conditions you put on it. Now, the economy as it was before this crisis is probably never coming back. So our objective should be, what can we do to stimulate as much economic activity as possible? To ours, there's a debate on the logistics side and there's a debate on the production side. We need logistics to enable an adaptation to happen on the production side. So we need e-commerce and we need to support people digitally to be able to function remotely and so on. The more effort that's put into enabling the distribution side of the economy, the more possibility there is for the production side to adapt. So that kind of thinking we haven't really seen in evidence in the South African policy response. It's rather been a micromanaged opening and closing of different pieces of the economy, whereas what we'd like to see more of is a macro response that says this economy will adapt and we need to maximize the distribution capacity.
Thanks, Stuart. Then we have a question about, we'll share the presentation, we'll put it on our blog, and it'll be up there probably by this evening. So that's definitely not a problem. I think we had a hand up from Ashok. We'll come to you in 1 second, Ashok. Stand by. So then from Ernst, we had a question on the next stages for the IMF, which links into a question from Matthew as well on size of an SBA. So I wouldn't say it's our baseline that South Africa has to go for an SBA, but it's highly likely, I think, if you have a very skeptical view on nominal growth and structural reform happening, it is basically the only option. Now that can happen later rather than sooner, particularly with where yields are. You can keep basically funding yourself at unsustainable, long-term unsustainable yields above sort of 10%, with the SARB only providing sort of minimal liquidity backstop from not QE. But as I said, there are other alternatives. The SARB could step in first before an SBA and try and absorb a larger amount from the market. We're skeptical on that before an SBA, or something like a China loan as well. But all these, I think, kind of really delay us. I think the economy ultimately can't get away from enforced structural reform. You either do it yourself or someone imposes it on you. And that ultimately is then, if it's not yourself, is then the IMF itself. To Matthew's question on size of SBA, the 50 billion, now there are a huge range over history of what SBA sizes can be. Greece was obviously one of the largest ever, and Argentina, etc., where you were coming in at sort of 20-30 times quota. We've assumed 10 times quota, which is sort of around where Turkey was in 2001. Is just an assumption. It would be highly challenging, I think, to try and think about this. The other question we often get asked is why you would even get an RFI or an SBA if you don't have a balance of payments problem. And this really speaks, I think, to the fact that South Africa doesn't have a balance of payments crisis, but is on the fiscal cliff edge. A balance of payments crisis is when you have a huge structural demand for dollars in your economy. Say you have FX mortgages, like Hungary did coming into 2008-9, like Turkey does has done in the past in terms of FX corporate loans. South Africa doesn't have this, but the IMF has a great degree of flexibility and has sort of clarified this through the Greek crisis period to offer what is balance of payments funding for countries with fiscal problems, because of the simplistic view, which is correct-ish, that any country that properly falls over the fiscal cliff will also have a balance of payments problem, as you see flight of foreign investors, etc., going on. But the simple answer to those questions is on the size, very hard to say, but we've made that as an assumption. And yes, an SBA is quite possible over time. We'll come to Ashok now, if you want to, or has he put his? I think he's put his hand down. He put his hand down. Okay, shame. If we, 1 second, let me just check something. Okay, more questions. So from Mariam Issa, thank you for joining, Mariam. The impact on Ramaphosa. So we get asked a lot, and there's a lot of pushback we get from people in South Africa around praising leadership or not. And I think this comes back to the issue of fundamentally what is going on. We have seen leadership certainly to act so early in terms of putting in place a health solution that was definitely positive. But equally, we haven't in terms of seeing a fast response on the economic reform package and a delay in that. And arguably, South Africa could have waited maybe a week or two in putting in place a health response to really get into gear the economic program. So I think that the leadership question is not a sort of done deal when you start really digging into it. And I think this is the point, again, politically also, of this ramp up of cases into the sort of September peak is it's going to get a lot more politically challenging when you start having, say, daily death rates that are in 3 figures. For instance, this will become a much more of a crisis, I think, hands in the air style crisis. And equally, I think when you start seeing those very challenging decisions having to be made around cliff edges, such as on grants at the end of the year, is another crucial leadership test point. I mean, I think this certainly does buy Ramaphosa some additional political space and political capital. But I think, you know, the long-term issue for the ANC is going to ultimately rotate around people's material standards of living, which are going to be negatively impacted. And as a result, through the next midway conference, which might be in the first half of next year, the next elected conference at the end of 2022, there's still going to be an oppositionary force to Ramaphosa that can spin a dynamic around the impact on people, around not doing enough on the economic stimulus, etc. And that will have some grounds. Now, I think the problem always for forecasting and long-term forecasting of politics is it's never been about what is best, but about what's the least bad, or can sort of who can outlive their foes. And so our baseline very much still is around Ramaphosa would continue through the 2022 elective conference. The probability maybe has marginally shifted now, but yeah, I think that he has done okay, but there will be plenty of cause for creating a lot of political angst and contestation later on. Stuart, maybe we just want to come to you quickly now on the bond, the idea of the bond, COVID bond. If you want to make a few comments about that, there's been some questions.
I see Anthony asked about the COVID bond. Anthony, there's still discussions ongoing. There's some market sounding happening to just get an understanding of what potential appetite would be. We've had some encouraging conversations with both local and offshore investors. So it's still something in development, and one we think could be quite helpful in some of those funding gaps that Peter mentioned.
Great. Thank you, Stuart. There's some questions on markets in general and our assumptions around markets. We haven't penciled in anything too dramatic in terms of the rand. We have it basically selling off a little bit up to 20 and then sort of coming back through the following 2 years, eventually to around 1750. That's basically because we think the steepness of the yield curve will prevent any sort of dramatic outflow shocks. We're now going to be largely through the Whigby outflow shock, and we think these are pretty long-term. This is always a mug's game, as I know, trying to have done this over my career in terms of currency forecasting. But we think the currency is undervalued, probably at this point, but for good reason, and that sort of undervalued nature can continue for some time. The real issue, I think, is what happens next year with the SARB, with the interest rate. The SARB is currently now sort of playing with sort of being ex ante negative real rates. But I think if you have a situation next year where rates are not hiked and inflation is starting to move higher above the base rate we see after another cut in May of 50 basis points, then I think that's really the question of what direction the currency really does start to go in. If the SARB did properly step up and do a much larger expansion of liquidity that caused, say, the front end of the yield curve and the money market to sort of crash through repo down to the standing depot floor, which is 200 basis points below, that could have a much more negative impact on the rand. So whilst our baseline is moderately boring and sort of flattish, the risks are for us to the upside in dollar rand, and I think that's probably the most we sort of want to say overall. Another question from Mariam on SOEs. For Eskom, it seems that Eskom will, we think, get into a liquidity basically sticky period through the next period of lockdown. They currently, in the last week, total demand for electricity was down about 22%. That directly falls into their bottom line. And they, I think, are okay in terms of debt service costs. Let's remember that Eskom is backed by a 56 billion guarantee this year, which is aligned and structured around making repayments for its debt, and we don't worry about very much about the $21's repayment in Q1 next year, which we think most of the 56 billion bailout is structured around. But the problem is that bailout actually is non-fungible. You can't use that bailout under the rules to ease liquidity pressure, say if you run out of cash. And so for us, the key period is really when you come over from what is normally a cash-rich first half into a cash sort of challenging second half of the fiscal year for Eskom. So this sort of move from September to October for us, which will be after maybe another period of stage 5, will be deeply challenging for Eskom. And so we are thinking about this as a scenario. This is not baseline necessarily, but is a quite probable scenario that Eskom would have to have additional bailouts halfway through this fiscal year to ease basically a deep liquidity crunch for it at that time. For SAA, the impact is obviously being in line with other airlines globally, but actually, compounds the fact it's in business rescue. It basically is running out of money now into the next sort of 2 weeks after paying April payroll. And we basically see no way that, given there's no money, no guarantees coming, that there can be a successful outcome for the status quo at Eskom, at SAA. It's ultimately about what happens to Mango. We think Mango probably can be sold in a fire sale, and there probably would see quite a number of interested buyers as a decent asset in and of itself. But the status quo, basically, unfortunately, with the employment levels that go with it at SAA, the airline group level, as well, is simply unsustainable. And for us, the strategy that's been played out here is a political one to allow government basically to say they've taken absolutely every possible route to making this thing survive. And politically, we think the only way they can really do that is by running it into the wall at the end of May, and that's ultimately what will happen. We have a question on debt issuance. So we've sort of penciled in this 25% step up in SOGB issuance. We think that's parallel with inflation-linked bonds as well. A dollar bond issue is very hard to see right now, given where yields are at. We think there's an interesting sort of sequencing to think about a normal euro bond issue when you potentially have sort of excess liquidity offshore as foreign and developed market economies start recovering. South African offshore yields maybe fall off, and maybe it's easier to time that at that kind of juncture as opposed to paying very high required coupons. But hence the interest in sort of doing COVID bonds a lot earlier, given the dollar market probably is closed in the very short term for normal issuance, given the cost of debt service costs that would really come there. There has been a lot of concern in bucket risk and redemption risk, and I sort of have done many things in the last couple of weeks around South Africa that one would normally do maybe in terms of other African countries, such as redemption profiles, such as cash modeling of treasury. These sorts of things you do only when you're at the liquidity cliff edge. We think there is, and in terms of this sort of expanding fiscal space at the cliff edge, we think trying to do ultra long bonds, tapping new sources of investors like sovereign wealth funds would be best, but also T-bills as well. I think there is a lot of cash now sitting around as corporates have moved into cash. But for us, that key 3-year sort of bucket is proving to be quite risky. A lot of questions from investors around that bucket and redemption risk. And let's not forget that if you got an IMF RFI, they normally redeem sort of in 3 to 5 years. And so you're probably adding on top redemption risk around that period as well, around that 3-year bucket. So we're quite concerned around that, and hence we would want to sort of see issuance parcel to the opposite extremes of the yield curve. There's a question on oil and Sasol in particular. Sasol has come up as a sort of key strategic interest. But Stuart, do you want to maybe have a quick word about that? Hope you're on mute.
I think, look, oil, everyone's trying to make sense of. We're certainly not oil traders, but WTI and negative prices has been certainly a headline grabber, but we see this as a result of physically settled futures rather than a fundamental reading of supply and demand in the marketplace. Once we get through those technical issues, there is going to be some level of demand, and we'll see that demand recover as the economy stabilizes overall. Obviously, very negative for Sasol, but the sharply weaker rand is positive. So those two have to offset against each other. And, Sasol got a very stressed balance sheet. So whether it has to go into the market for an equity raise, I suppose, is the real fear. We'll have to see what happens. Certainly, it's in intensive care.
And there's a question then for Ambassador Stuart on multinationals. You see that one? Yeah.
So Vas is asking if we might see multinationals open up production in response to a deglobalization and a permanent change in logistics. I think this is really going to depend on what kind of scenario we end up with. If this disease is a one-season disease and whether through either natural immune response or vaccines, it becomes it is dealt with, then normal international trade might resume, normal production might resume. If it becomes a seasonal scenario and something that we have to deal with on an ongoing basis, then things can be permanently different, and it will be the production side that changes. So, rather than multinationals moving into Africa, we could easily see a greater concentration of production, because production is going to be much more difficult with permanent health constraints and protocols having to apply. The logistics side seems to be easier to happen within health protocols. So very difficult to read the outlook. There is certainly an increased nationalism. So a lot of the crisis response has been that there wasn't sufficient domestic production available of PPE and ventilators and so on. So there is at the moment a strong nationalistic call for greater self-sufficiency for pandemic crises, and we can add other crises that can be imagined in future that we might want to increase domestic production for. So there will be some level of nationalistic production backlash, but that has to be weighed against the urgent need to boost economic growth. And if we're going to kind of reverse international trade, that's going to be a serious constraint on global growth that we just can't see, that constraint being accepted given the urgency of boosting growth.
Great, thanks, Stuart. I mean, there's another question from Claire on what real QE from the SARB would be. So we call what's happening at the moment not QE. Basically, the SARB gets very upset if you do call it real QE, and I think they overlabor this point that real QE only happens at the zero lower bound, which I don't think is necessarily true. I mean, there are two components, let's not forget, to what happens in terms of operations. So the SARB currently creates money and it goes in and buys bonds. That has an influence on the bond market, but it also creates that created money entering into the monetary system is then not fully sterilized at the front end, and hence front end rates fall as the SARB buys bonds off people. They have cash which they have to do with something with at the front end of the yield curve, and it's those two components which are quite different actually, and are actually of equal importance, but for very different reasons. A proper QE program really would be for us targeting, say, yield levels such as capping at 10%. Or as I said earlier, taking in a certain percentage of a funding gap like 250 billion through the secondary market would allow then primary dealers to buy more, knowing the SARB was there to take off from them, and would create a different mindset as opposed to at the moment it's just liquidity backing, where the SARB theoretically could allow yields to go all the way up to 20% as long as you were seeing two-way prices and liquidity and people could easily buy or sell. It's really the ease of buying or selling that the SARB is targeting, not those yield levels. But this is a complicated process. South Africa and the SARB in particular has always shied away in the last sort of 10 years from Turkey, Hungary, Brazil style sort of crazy postmodern monetary policy. And as a result, now I think the markets have to understand a lot more, for instance, how the front-end monetary system works, for instance, how overnight SARBOR could crash lower to standing depot, all these sorts of things, which no one ever really had to think about in the past, and now important components of what's going on. And that shouldn't sound scary. I mean, from the SARB's perspective, I think that should be a positive. It gives them actually an expanded toolkit to micromanage things more if used credibly and well. And the SARB, of course, comes from a very deep sort of wellspring of credibility and sort of the benefit of the doubt from investors, certainly. So I think the answer there would be the SARB shouldn't be afraid necessarily or pushing further down that road, but equally I think will be very resistant until they see real evidence of conditionality around structural reforms, which really probably comes from an IMF SBA. There's a question there on the timing of a new budget. It's not really clear. I mean, last Friday's statement from Minister Mbweni was meant to be a more detailed statement, maybe with some accompanying releases, and nothing really in terms of any detail was offered. We basically need to see a full whack budget in terms of the detail, at least, that will be coming out. And I think it's the booklet that will be far more important than the speech. Our understanding is it will probably happen in a couple of weeks' time, but it's very difficult to say when it should occur. And this is the game of cat and mouse I think the market is a little worried about. If you wait to increase SAGB issuance until after a budget, and you're waiting longer and longer, you're squishing that extra issuance into a shorter space of time for the rest of the fiscal year. And equally, I don't think you can necessarily increase issuance before an emergency budget, or at least before a full understanding of the fiscal framework is laid out. Maybe you could, but you wouldn't be able to do as much as and create the fiscal space, certainly for doing as much as maybe you want to after you've done a release of an emergency budget. There's then a question, Stuart, in the Q&A on a second sort of double dip for stocks, how you sort of view the path there.
Yeah, it's investor decision making under uncertainty, and as time goes on, that uncertainty narrows. So we'll get greater clarity. For now, investors are working on guesswork. As company results come out, we will get confirmation on the projections. Are the numbers that are going to come out going to be shocks to the projections? Well, obviously, I would be contradicting myself to say yes, because we can only work with our projections to guess the future. So far, the projections, I think, are in line with where people are. So on the banks, for instance, we've had Standard Bank give us some insight on their first quarter, which had 1 week of the lockdown, and they've taken a 27% year-on-year drop in headline earnings. We're seeing US banks, for instance, increase provisions by 4-fold, which is a really extreme increase, but ones which still leave some level of profitability there. So we're starting to see those numbers come in. There's also more real-time numbers that we can track. For instance, the numbers of transactions being made across the economy, where you can see the hit in real time, things like traffic volumes and so on, give you more real-time indications on what's happening. All of those factors are going into models to project underlying earnings. We have had a very substantial stock market adjustment. It's been greater than we saw in the financial crisis, and it happened within a few weeks. So there really has been a big repricing. And for now, we're not seeing any shocks to the projections that are being priced in.
Great. There's a question on the Africa Free Trade Agreement. And I mean, I think for us, this was always a big long-term positive, but was sort of unquantifiable, untimelineable, and was a very hard thing always really to think about, and is more important than ever. It comes back to this point that structural reforms shouldn't stall just because of the crisis. I think across the continent, people, a small pocket of people should be still burrowing away at this and trying to get this going. There are key deadlines coming up in the middle of the year for the implementation of the first round of trade protocols and trade standardization that I think shouldn't, well, probably would be delayed, but I think shouldn't necessarily be delayed. It's all about accelerating the recovery when we get there. But I think the fear really is the increase in nationalism that we may see, the demands for, short-term import substitution on things like PPE grow into bigger calls for sort of onshoring and industrialization. And this is the debate that's happening in South Africa, which I think Stu and I have both been to the party to, is this idea that this is a sort of golden opportunity to sort of stop trade and to sort of have this sort of domestically lovely self-contained economy. For us, just isn't workable. And it comes back to Claire's question on our problem with the multi-stage is how you sequence your supply chains, when they're sort of spread across different stages is I think deeply problematic. And equally trying to sort of magically onshore complex supply chains, I think will cause some deep problems. And as a result, some openness is needed. I think probably the simple answer on this question is we will see, as usual, the sort of West and East trade blocks do very well at keeping integration going. But this sort of, for us, always the key issue was joining up the East and West block with the Southern block. That probably will be somewhat delayed. And the full sort of might of the free trade agreement probably takes quite a bit longer really to come through. So just wrapping up, we've taken up a lot. There's still lots of questions coming in, but we've taken up a lot of people's time. The question from Ashok, who didn't put his hand up in the end, on the political economy consequences. I think this is the key risk. I mean, as I said, we see Ramaphosa continuing, but you can, I think, make a political case against him, and it will be made against him after this through a midterm conference and into an elective conference, based on the delay in putting the stimulus plan in place, based on the slow recovery, based on the permanent step up in the unemployment. But that's not a new view. I mean, we were always viewing the National General Council as this key moment when forces aligned to Ramaphosa would make this case of that NHI wasn't implemented, that unemployment was grinding higher. We'd even sort of forecast that by the time of the elected conference in 2022, you'd probably see north of 30% normal unemployment. Now we're probably talking up to sort of 36, 37% normal narrow definition unemployment. So that sort of nature of the forecast is still the same, if you like. It's just flexed through a different vision. But ultimately, I think the issue still stands, that there are enough alternatives in play here at the moment. We've had a lot of questions from people in the last month. Is someone a Macron-esque character emerging as an alternative? Is any political figure whipping up social unrest on a political front? Those things are not happening at the moment. We don't see those things happening, but it's always the unforecastable event in South Africa. We are watching for that. At the moment, the unrest, the looting, etc., is very much sort of food-driven. In particular, reactions against police brutality, etc. We're not getting any sense on the ground at the moment at all that there is any sort of politicization or joined upness in that kind of action. But certainly, a lot of investors asking us questions is a very right thing to be looking at and concentrating on in a country like South Africa. Then there's a question on debt. So our forecast basis, we step up to about 80% basically in the current fiscal year, and then we basically keep grinding higher, albeit at a slightly slower pace in future years. And this comes back to the psychological issue that you do need to see a stabilization in debt to GDP. Ultimately, that's what an IMF SBA would ultimately look for overall. And if you don't get there, one of the issues that I sort of missed out earlier is one of the sort of partial options that we don't think the government will take, but is certainly front of mind for many investors. Mariam's asking again on prescribed assets. We've always said that prescribed assets is far more complicated than this sort of numeric requirement for bond funds to put in place to buy certain amounts of developmental assets or SAGBs. For us, it was always a much more complicated arc of political pressure, of threat in terms of licensing at some point potentially, particularly around, say, banks and coal financing was an issue we saw coming to the fore before this sort of crisis emerged. And there's certainly on the way out of this, I think, and around an IMF SBA, say, in future, going to be a huge amount of discussion on the role that prescribed assets should be. The president highlighted as part of the stimulus plan that infrastructure would be crucial, an issue that Stuart and I worked on a lot. And that's also an area where the prescribed asset debate comes in as well. But what we've always said, what I think Mr. Mbweni said on Friday as well, that there's plenty of money out there, and money that's very willing to invest in decent projects. And there are a lot of decent potential infrastructure projects out there if you can see the right government governance, legal and fiscal frameworks put in place around it. So for us, prescribed assets is an important political debate. It will rage. It will become more important in some sense. But fundamentally, we don't see that really coming into as a policy option, given the impact it would have. So I think that pretty much exhausts the questions. We've been going for a good amount of time. Thank you, everyone, for sticking with us. Any closing comments, Stuart, you'd like to make shortly?
Oh, thanks very much for joining us. Obviously, our email addresses, hopefully you've got our contact details. Please drop us any questions. We'll be happy to answer that way. We'll also post this video on our website. So if any of your colleagues would like to see it, it will be available there, and we'll let you all know once it's there and send you all a link, including to the presentation.
Excellent. Well, thank you very much for joining. Yeah, we look forward to talking to you all soon, and we might do another one of these in a little while. But have a good day, everyone. Thanks very much.
Cheers.